Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Greene is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equities Profits Podcast. I'm Cliff Locks, your host. Today, our guest is Chris Miles. He's a leading authority on quickly creating wealth by increasing monthly cash flow and creating passive income. He's the founder of Money Ripples, host of the Chris Miles Money Show, and the co-author of Entrepreneur on Fire. Chris has been featured in the U.S. News, CNN Money, and Bankrate.com. Chris, thanks so much for being here today. I'm excited to have you on.
A pleasure to be here, Cliff.
Tell me about your background and how you got started and what led you to the financial services.
Yeah, it's not the way I intended it to go. I went to college. I was a sociology major with a triple minor in psychology, Japanese, and ballroom dancing. Cool. So little known fact, I was one of the nation's top amateur ballroom dancers about 20 years ago and 20 pounds ago too. So anyways, did that. And my intent was to become a business consultant. So I was going down that route. I was going to, finish, get my bachelor's in sociology, go get an MBA and so on. Well, in the middle of that, I realized I don't want to just have book smarts or just have a degree and then no experience. So I figured, well, how am I going to get real business experience? Well, I should take a sabbatical. So I took a sabbatical with one project left to go for my bachelor's, right? I took a sabbatical. I was like, I'm going to take a year off and find some business to start. Well, the first business that came my way was becoming a financial advisor. Little did I know it was so easy to become a financial advisor because all I needed was somebody with a heartbeat and they could pass a couple tests, right? And so I went that route, but I loved being the entrepreneur. And so I loved having control of my own time and my freedom. And so eventually I dropped out of college and went that path. And I did the mainstream traditional financial advisor path, selling mutual funds, insurance, annuities, things like that. Did that for 4 years. But during those 4 years, I started to realize, because I'm the kind of guy who likes evidence, right? Just like I know I need to get real life experience to become a business consultant, I also like to see evidence that what I'm teaching works. And when I started to look at my clients, or even in clients I'd inherited after decades of advice from other advisors, I realized something. None of them were financially free. Maybe some of them were at the point of retirement, but they were still worrying about running out of money, right? They still were worried that they would outlive it. And the truth is they might. And so I realized, okay, there's a problem here. But again, there's that dilemma. Your pocketbook's tied to this profession. What do you do, right? And so at that point, when the student's ready, the teacher appears, right? Ironically, I didn't expect the teacher to be somebody who I had hired to be a financial advisor to work with me, then quit and went to do real estate investing. And he came back, it was a few months later, and I called him up. It was end of 2005. He said, hey, I want to wish him Merry Christmas, Happy New Year, all that kind of stuff. Mm-hmm. And deep down, I was hoping that he was going to say he was struggling so then I can bring him back on as a financial advisor again and start building our team. Well, I was disappointed in that. He was the exact opposite. He started saying things like, man, Chris, it's awesome. My dad and I, we partnered together on some real estate deals, and now we've doubled his income as a professor at the local university. And I said, in 4 months? Come on, that's too good to be true. Besides, stocks are better, and I started arguing with him about, stocks versus real estate, right? Because I was even teaching people how to trade stocks and options at that time. Well, he finally stopped me. He said, Chris, well, how many of your clients are actually financially free where they don't worry about money? I said, well, none of them. Well, good job, Chris. Way to go. All right, Chris, how about this? How many of you financial advisors, including yourself and everybody else in your office and anywhere, how many do you know that are actually financially free, not off the commissions, not off the trails and renewals, but actually off of the mutual fund investments they've been recommending? And I thought about guys that I'd been working with that had been doing financial advising since the late 70s. And I said, none. maybe that one guy. And I found out later he wasn't either. Once he got let go from the company, he was struggling to try to scramble, find money. Right. And so I realized, okay, you got me. What now? He's like, I'm not even going to tell you an answer. I'm like, come on, give me something. You just got me to, acknowledge the fact here that yes, there could be a hole here. He said, all right, if you're really serious, get this book, Who Took My Money by Robert Kiyosaki. That's a lesser known rich dad book, right? Basically says mutual funds are horrible, right? And then he said, and go listen to this local AM talk radio show. This is pre-podcast days, of course, right? And these two real estate investors were teaching this stuff. Well, lo and behold, a few months pass. I got to the point I said, I can't teach this anymore. I'm out. I quit being a financial advisor. I will now 2006, I'll be a mortgage broker because everybody needed a mortgage broker back then. And I'll teach ballroom dancing on the side, and even some stock coaching too. I was doing that as well. Well, anyways, as time went on though, it drove me nuts that some of these guys that were in this real estate game were financially independent, in their 20s and 30s. Some of them were younger than me. I thought, I got to know what these guys know. And so I started getting in that space. And the next thing you know, by middle of 2006, about the summer of 2006, I was financially independent myself, 28 years old, completely shocked. I didn't think it was going to be that easy. My whole goal was save up $2 million in mutual funds so that by the time I was 40, I could retire, right? But I did it much faster with less cash because, again, it wasn't about accumulating money and trying to live off less than the interest as the traditional model says. I thought, no, it's about cash flow. What kind of income is it generating? So that changed everything for me. So 2007 came out of retirement, started teaching people how to do that, partnered up with some guys that did that. Eventually in 2008 hit, we were focused on some gambling real estate investors. So the next thing we know, our business was in trouble. So I went from millionaire to upside down millionaire and went back into the rat race during the recession, had to dig my way back out. Didn't file for bankruptcy, but I did go over $1 million in debt doing it. And eventually dug my way back out where in 2016, I was again financially independent, doing what I'm doing right now, teach people how to get out of the rat race, how to work because they want to, not because they have to, and have enough passive income to cover their needs and beyond.
That's extremely interesting. In other words, you see the whole gamut with your life. And you don't take anything for granted.
No.
You've seen the wealth. You've seen it where it turn upside down. Cycles are very normal in our financial community. And how do you look at it and stay positive? And then you find your way in a good direction. A lot to be proud of. It's learning. And I'm glad you surround yourself with some bright individuals that helped you, look at other opportunities, especially in real estate. It works extremely well. Money is very inexpensive at this point. So you'll tell us more as we go forward together. Yeah. You're the founder of Money Ripples. Tell us what it is and how it differs from other financial firms.
Yeah, really, Money Ripples, we work like an anti-financial advisor, right? We're telling people to do the opposite of the main Wall Street that's out there. The same old stuff we hear like from the Dave Ramseys of the world, right? Okay. Save everything, spend nothing, put it in mutual funds, save it forever, and hopefully someday you got something. We're teaching more about how do we create cash flow today? How do we find and free up that cash? How do we get it to work for us? How do we really get to where there's passive income so that you're work optional, right? You can keep working if you choose to, or you can, retire or do something else, or take that next step. And that's really the whole point of it. And it's creating that ripple effect, not just getting financially free yourself, but then as you do so, be able to create greater impact in other people's lives in your community, through your family, and generation to generation and beyond, right?
Let's drive in a little deeper. You call yourself an anti-financial advisor. What do you mean by that? What makes your approach different?
Yeah, because we're not, we pretty much don't recommend mutual funds. I mean, one, we're not securities licensed. That's a big one right there. I had to drop that when I was doing stock coaching. Funny enough, my broker dealer says, choose us, you choose stock coaching. I said, stock coaching, because I know I can manage and make more money doing it on my own than I can with an index fund. So anyways, we're not licensed to do that kind of stuff in the sense of selling mutual funds. But then again, mutual funds, if you look at the indexes, even if people are doing the spider or whatever they're doing, right? For the most part, it's high risk, mediocre returns, right? I mean, when you look at the real, the SP 500, through to date for the last 30 years, has been an actual yield of about 8.4%, right? Not 12, like I used to proclaim as a financial advisor, because it was based on averages, not actual yield, right? And there's a big difference, but it wasn't that much. And so what we do is we look outside of Wall Street. We look at more into the alternative space. So things like buying real estate, things that have been proven to work already. Do we buy real estate properties? And I like more like passive type real estate, not the active stuff as much, even though somebody could do that. more of the past stuff. Like, do you get a turnkey property where you just buy it, you don't maintain or landlord it at all? You're purely just somebody who buys it, finances it, and then collects the checks, right? Or are you doing things like syndications or different alternative type of funds where you're doing things where you're, having it invested in those spaces, or maybe you're pooling money with other people to invest in like a big apartment complex or self-storage or, whatever it might be, assisted living, or, even doing land deals and things like that. Like, even oil, right? I mean, there's lots of different things you can do outside of the traditional, boring, old, stale mutual funds that are out there and get a much better, safer return than what you would get otherwise. We offer more of that variety, helping to connect and strategize. Again, we don't raise money for ourselves. We don't have any investments ourselves, but we do have lots of contacts, people that are in that space already. They're already doing those things,
Very good.
Have great track records. In fact, I know there's, a few guys in there that have been, paying consistently. So for the 20 years they've been in business, they've never missed, even through a couple of recessions, they've never missed their payments, on whatever they guaranteed. And so that's the kind of thing we're looking at, is changing their mindset out of the accumulation model, which is save, compound that interest forever, and more into an acceleration model of cash flow, like what generates income. So dive even deeper than that. Let's give you an example. I had a guy come to me recently. He had about $3 million or so saved up in his mutual funds and IRAs. He was 53 years old, done a great job. He's saving over $100,000 a year. But, the thing is, he met with his advisor, and his advisor says, well, good job. Keep going, right? You keep this up, maybe in your 60s, you'll be able to retire. And now remember, this guy is saving way more than the national average, right? Way more than people that even max fund their 401ks. And the financial advisor says you might be able to retire. The reason he says that, because he knows that this guy's goal is to live on $500,000 a year. He's not spending $500,000, but he wants more than enough to cover his needs and then some, even with inflation, right? In that model, he would have to save about $15 million with his advisor, but we're not wanting that, So I told him, I said, listen, even when we get a decent, just 10% return, that's pretty, it's kind of like our baseline minimum of what we want to earn in any investment we do. Even at a 10% return, that now $3 million is $300,000 a year, not maybe $90,000 a year right now if you were to stop and then you pay taxes, but $300,000 a year. And then we can even get tax advantage money where little to know that none of that goes into taxes. It's a very different mindset to have to shift around to do that.
Breath of fresh air. Address the tax burden on the front end and really understand what you're putting together and what it looks like. A big part of your approach is freeing up cash quickly. What are the best ways to do that?
For most people, it depends on where they're coming from. Like if they are like the Dave Ramsey poster children, we don't have to worry a whole lot about them tracking their money because they're probably already overly anal about how they track their money, right? And they're probably super scared to spend a dime. But, there's a lot of people out there that, they have more than enough money coming in, because most of my clients make multiple six figures, right? Okay. They have more than enough money coming in and they just don't track it because they have enough of it coming in. It's like air. It's kind of like what happened to me in 2007, right? I had so much money coming in. I didn't need to track any of my money. But then, of course, when things got tight, you can guarantee I was starting to track it, wasn't I? I should have been doing that from the get-go and start to really look for those money leaks, right? So tracking money is always a great one. Taxes is always awesome, especially if you have entrepreneurs. I mean, I guarantee if I have an entrepreneur, we find at least $5 to $10,000 a year they're overpaying in taxes, just because there's little strategies that their CPA, who's more of a passive CPA, that just says, give me your numbers. All right, great. Here's your tax bill, versus here's some actual planning behind this so we can reduce your tax burden, right?
Let's go deeper into that. You brought something up extremely important. We have a tax professional at this point. They're filing the taxes, but are they really a consultant and really understand the DNA of myself, my family, my businesses? Yeah. And bring forth a plan. You got the financial planner, you have an attorney, you have an accountant. So you're really missing somebody. Or it takes a very unique individual in one of those positions to help with that guidance.
It does. Yeah, you really do. You really want somebody who's more of an active type of CPA, right? Somebody who actually says, all right, based on your situation, here's some strategies to employ. And it's not that hard. I mean, it's really sad when I've done several webinars on taxes, and I'll put the disclaimer, I'm not an accountant. But the sad thing is I just give like maybe 5 or 6 points of ways that entrepreneurs can reduce taxes. And they say they've learned more in those few minutes than they ever learned from their accountant in 20 years. That should never be the case, right? That it should never be that kind of relationship where you're just giving them their numbers and they tell you what the tax bill is. It should be the opposite, where they say, all right, here's a way to pay your children. And by the way, did you know you can pay them tax-free Now you have them pay for their own stuff, or,
Right.
hey, can we use the Augusta rule? Where we can use that, we can start paying for 1 day's use of your home office, especially now most people are starting to go more virtual,
Right.
even an easier situation, right? Things like that. Or, how about like how we, pay with like using like a corporation, for example, what's salary versus the dividends? So many times, even an accountant that teaches them to do that will say, well, let's do a 50-50 split, salary versus dividends. I'm like, wait, we can easily justify a 30-70 split, and that 20% might easily save you like 10, 20 grand a year right there, just because you're being taxed as an employer, not the employee. Just little things like that come up. A CPA should be already honing in on and saying, all right, here's what you can actually start to apply in your life right now.
There's a shortage of them.
There sure are.
Yeah.
And that's why we need people like you, where you got those kind of connections too, right?
Well, I have this dynamic conversation usually with fellow CEOs or board of directors, what they're seeing on the consultant side, and you see gaps.
Oh, absolutely.
I've had conversations with Tiger 21, so you're looking at most people, need 10 million minimum, but most people have $100 million and they're getting together, and it builds trust in Tiger 21 because who you're sitting across from or now on a Zoom call is wealthy in their own right. Most of them are self-made. At that point, you can get into those details. The conversation is very, very positive. It's a collaborative environment where they're trying to solve real challenges they have, obstacles they're trying to work through. And real estate does play a major role in most of the wealth that's being generated, or somebody had an exit for a business. Once someone has cash that they free up, how do you take that and convert it into passive income? What is your investment process?
Yeah, that's where we should really try to match them up. Right. The first thing we look at are, really there's two things we look at, two variables: goals and timeline. Right. Like, for example, I had a lady I talked to this last week. She said, hey, Chris, I don't know if I'm really somebody that matches your criteria because there's not really much to free up for me. Or are you okay to let it grow for a little bit? Now she's going to be 59 and a half in just a few months. So she could do cash flow pretty quickly with it. But she's like, no, actually, at 62, I would like to start getting some cash flow from it. I said, okay, about 3 years out. Perfect. Okay, well, let's focus more on growth versus just cash flow now. I mean, cash flow is great, but for that IRA, let's look at growth. What are some things we can do with that money? What are ways? And there's some, companies or certain types of investments that might be shorter term than just like, for example, we could do things like life settlements, for example, but that could take 10 years before you get the payout. We don't want to put in that kind of timeline. We want to look more shorter term. And maybe there's a 2 to 4 year investment type out there that's a syndication that she could do, grow her money. And then after that, start to do ways to pull out, create some passive income from it after that point, even if we reinvest it later. Sometimes we do short-term lending, that's always a great way to do short-term stuff, but most of the time they don't want to take self-directed money, right? So it has to be a specific thing. We even looked like land partnerships. Can you start doing seller financing and flipping land with that money and just let it grow and accumulate? I mean, heck, even my own portfolio in the last 2 months, it's done about a 70% return. I'm okay with that. I'm not expecting that every year or every 2 months, especially, but hey, I'll take that for growth purposes. And vice versa. If somebody says, hey, I'm looking to really retire sooner than later. I want cash flow. Great. Well, let's start looking at some of these things. Do we do like investment real estate instead? Do we start looking at some syndications, but maybe they pay you quarterly versus, paying it annually or whatnot. So it's just always trying to match up with the right deals once the money starts coming in. And it depends too. If they're just starting off fresh, maybe they don't have that big lump sum right now, but they're just starting to accumulate. I had a guy that was saying, I just bought a practice. I'm putting all the money there, but I'm going to have some extra cash now. What do I do? Well, that's why I said, well, okay, we can just put it in the savings, which, or a brokerage account or something. That's kind of lame. It's not going to do much. Or, there's a type of strategy I call max ROI, infinite banking, different than the other types of like people that do whole life. Give you an example. I had a real estate investor send me his whole life statement from a company he's been putting into for 5 years.
Okay.
He won't make his money back till year 35. I mean, that's even for whole life. That is horrible. That is pathetic, right? So he won't even hit the break-even point for what he put in versus what he has in cash value. It takes 35 years. Usually it's 15 to 17 for a crappy policy, right? And I'm completely against that. I'm probably an anti-insurance planner too, in that sense. But I said, you know what? We can actually do it in 5 years, not 35 where you break even and far exceed it. And the cool thing is we can still take that money inside a life insurance policy and go and invest it. And we double dip, create double arbitrage. We're making money inside the policy and we're making money outside of it too, because we can get line of credit 3.25 while getting paid 5.75, right?
Very
So we're
smart.
making double the interest while at the same time investing in real estate or wherever we want to do. And so with the guy that's just starting his practice, I said, well, if you're looking for creative ways to build that up, here's a way to do it, especially when you get past those initial fees. You can, within the first year, you can actually go and start lending this, borrowing out of it and making money with it in the alternative space. There's always something for somebody, but it just depends on where you're sitting at right now.
So you like to focus on alternative investments.
Mm-hmm.
What ones specifically, and are there any that we should avoid?
The ones I like in general, I wouldn't say there's one that I go for, because if there's always one I'm always pushing, you should probably ask yourself, is that what I sell? Right. and we work more as consultants. So there's lots of options. I even had one client that refused to do anything with real estate. And real estate backed type of stuff is usually our preference. That's where the bulk of them. Yeah, just real assets. But I had one client in Hawaii who said, honestly, I don't want to deal with real estate at all. Even if I'm a passive investor in the syndication where they're dealing with all this stuff, he's like, I just don't want to be in real estate. We started to search around, like, okay, what is it you are interested in? He said oil. I said, okay, cool. Let's find something with oil. And so we found investment. He tried to buy his own individual oil wells first, which was, a little higher speculative risk. I said, don't do that again. Let's look at things that are maybe more like a fund where you have 40 wells in a fund versus you're buying one at a time and you either strike it rich or you don't. Right. And so he started doing that to kind of stabilize some things some more. There's something for everybody that way. Like you said, it really is mostly in the real estate space. Could be in the business space, like franchises. I have a real estate investor that they wanted to diversify more out of real estate. So we started looking at franchises instead, and so they just, I would call it semi-active or semi-passive because they probably spend a good 20 hours a week or so for the first few months. But then now, after they've got the key positions filled, now it's about 5 or 10 hours a week just to manage it, make sure things are running, but they're much more hands-off at this point.
Okay.
So there's a lot of different options.
Now, as we look at, a lot of the listeners here are very or ultra high net worth individuals. So they probably have $30 million. So when you look at that investment, a lot of us are focusing on private equity, real estate funds. I know you don't offer any to your clients directly, but what can you teach them how to use them in the right direction? What are the big lessons you teach about them? And do you see any trends shaping them now?
In the private equity fund?
Yeah, and real estate funds.
Yeah, real estate funds. Yeah, because there's some people I know like you that offer some real estate funds and whatnot. And I think those are great because if there's one way to diversify a massive amount of cash versus you having to hand select it, it's a great option. And there's even better if you have some tax advantages with it too, which a lot of times you could pass a lot of those depreciation things onto. The things you got to be worried about though, I mean, when it comes to the funds themselves, it's more about the fund manager than it is about the fund itself, right? Because the fund manager, you got to really know their philosophy. You got to like for example, like if I ever hear something out of somebody's mouth saying, well, it takes high risk to create high returns, right? I guarantee that is not the person I'm going to put money with because that's a gambler mentality, right? We all know from being investors that we try to lower or mitigate a risk down as low as possible to maximize our returns, right? We like low risk create high returns, not the other way around. So that's what I try to look for there is what's the methodology to have a good track record. How do they select their deals, right? Like I know one guy, he has a real estate equity fund and he even decided to do a small little piece just to go into speculative. He tried to keep the speculative more as a small piece where he has more of the stable earning type of, syndications or funds or cash flows that he has coming within it. But, he did a marijuana farm, It's like, okay, great. That's awesome. I wouldn't buy it. But he's like, okay, I'll just put a teeny percentage. It was like, I think 1 or 2% of this fund he put in there. Now it paid off. He ended up doubling his money in a year because the guy ended up selling it for a lot more. It was in California. It got legalized and everything. Great. He made a home run. Right. But you got to be careful too, because there's times that same guy also, had a rough year in 2020 because he had a lot of commercial property in New York, for example. Okay. So, it's good that they're diversified, but really it's really about the fund manager and what their mindset is and what their philosophy is. That's what you really should be looking for. Things that I like to stay away from, even though I don't mind small percentages in, or things that are more speculative, like, crypto. Like I have crypto myself a little bit, but it's such a small amount that even if it went to zero, it wouldn't make or break me. And I kind of feel the same with the fund. It's like, you don't want to have so much crypto that if it all of a sudden tanks, you're not going to lose something. You're going to lose principal or anything of that nature. It's not a bad thing to have as a growth aspect. And there's a lot of different ways you can invest in those areas. I personally love gold and silver. I usually buy the physical stuff though, versus,
Okay.
I don't really like buy ETFs of that nature, right? Or, that's why I don't buy REITs either. But, you might say you're like, hey, I got a silver mine, and silver mine gives us more consistent revenue and income coming in. Great.
Real business.
What a great way to diversify into another aspect of commodities, right?
Yeah, the crypto's been good to me. I have no complaints. I mean,
crypto's been very nice
I
lately.
think I got a 23% return, in a year. And it's like,
Yeah.
It's not a surprise because I put the time and the effort into the research behind it. And then I've got a team that's looking at NFTs. It's a non-fungible token.
Yep.
And we're moving in that direction. We're also looking at inflation. We got the Fed saying it's 3%, 4%.
That's bull.
Probably at 13 to 15%.
Uh-huh.
All right. So, when you're starting to look at this, what you're doing, we're seeing prices are increasing while the inflation is driving pricing. The question is this a sustainable business model with the amount of debt that's being acquired or looking like it's coming down the pike?
Oh, yeah.
In the direction we're heading in.
Yeah.
It's a little challenging. Chris, what will be your legacy and what are you most proud of in your career?
My legacy is really what I'm doing now. I mean, end of 2016 and going into 2017, I kind of, other than doing my podcast, I wasn't doing a whole lot. I was consulting very few clients. I was just maintaining, right? Because I didn't need the money. I was financially independent myself again, and much wiser this time around than I was before the last recession. But you know what? Both times I've got to that point of financial independence, I realized, one, I can't just sit around and do nothing. That just drives me nuts. Okay. And then two, I have to ask myself, kind of like the whole Spider-Man quote, right? Where much is, with great power comes great responsibility. Right. What am I going to do with that freedom? And that's the kind of reason why Money Ripples is called Money Ripples, right? Because it's not just about creating financial freedom for yourself. It's also creating that ability to create a bigger impact across the world and the community, your family and generations beyond you, getting them to create something new. I know we talked about this before we went on the air about, getting families to get it, get those principles, not just get the money handed to them, but understand those true principles so that they can keep expanding upon that stewardship they're given. And I believe we're all stewards. We're all blessed with a lot of God-given gifts and talents to use. And that's what I'm trying to do now. That's the legacy I'm trying to leave behind, is how many people's lives can I bless and affect through what I'm doing? And that's what and really that legacy, I want to go beyond me, which is, what are those people's lives doing as a result?
That's very interesting. I think you figured out the bigger picture. We can't take a nickel with us. Let's make a positive impact, make the world a better place.
Yeah.
Take our clients along with us in a positive ride and continue to scale. I enjoy sharing feedback from our listeners. I continue to receive warm thank yous for advocating on the benefits of creating paid internships, co-ops, and summer jobs that provide vibrant learning opportunities for our youth. It's a wonderful recruiting tool, as internship programs provide an opportunity to hire a known and mentor them into talented executives. I think you can agree that the best leaders are great teachers and mentors. Please consider adding more women to participate in your paid internships. Each of us can make a positive contribution and change the lives of our young people for the better, and it personally feels great. Chris, thanks so much for being with us today. Your approach can help anyone listening consider the possibilities to get their money working for them quicker in ways that they had maybe not considered before. I appreciate you sharing your story and strategies with us. Chris, please share your contact information, web address with our listeners.
Yeah, you can go to our website, moneyripples.com. That's MONEYRIPPLES.com. Great information on there. And then you can also check out my podcast, The Chris Miles Money Show. That's on all the channels like iTunes, YouTube, and you name it.
Really do appreciate you sharing that with our listeners. Podcasts are so informative, and you bring a lot of value to your listeners. And it's a privilege to invite you on to interview today and ask my listeners to listen to your fine podcast. Thank you to our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. This show has been produced by Market Domination, LLC.